Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So a guy's been feeling really bad lately, and he goes to the doctor. And the doc runs a bunch of tests, and poor dude's waiting in the waiting room, waiting for the result of all of this blood work and these tests and stuff. And the doc comes in, and he has this really serious look on his face, and he says, "Man, I'm sorry, buddy, you've got cancer." And of course, the guy freaks out, right? He's like, "Oh my God, I can't believe this. I don't want to die." And then the doctor goes, "Just kidding. You just have high cholesterol, high blood pressure, and pre-diabetes, and you're a prime candidate for a heart attack, but you don't have cancer." And the guy's like, "Oh, thank goodness, this is great news." Now, of course, it's not really great news, right? Dude has high cholesterol and high blood pressure and pre-diabetes and could drop dead of a heart attack at any minute. But it's a little bit better than having cancer. So, good news. We're going to go on our way and have a great day. It seems like this is the basic approach when it comes to inflation data. As long as the CPI ends up being better than the forecast, well, that's good news, even if the forecast was pretty bad to begin with. So I'm going to run through the inflation data here in a minute because, quite frankly, it's one of the reasons I am still bullish on gold and silver despite the big sell-off we had over the last couple of weeks and all of the volatility we're seeing in the market. But first of all, I want to thank you guys for listening to the show. I really do appreciate it. I know there's a lot of stuff out there vying for your attention, things that you can listen to. So thank you so much for spending a little bit of time with me. And I'm going to ask you to do me a favor. We don't ask for much here at the Midweek Memo, but if you would be so kind as to go to wherever you're listening to the show, take a few minutes and write a quick review. Give us those 5 stars. It'll help spread the show and help us to grow. Also, if you would, share the episodes on your own social media. It just helps grow the show. It makes it better, and I would just really appreciate it. So if you would do that, I would say thank you. So, let's talk a little bit just about what we've seen in the gold and silver market over the last week or so. The gold bulls have taken quite a beating. Yesterday, gold spent most of the day below $4,000 an ounce. Now, this morning, we're up back like $75, and we've recovered the $4,000 level. And it's possible that 4,000 is going to be kind of where we're going to find the support. It wouldn't surprise me, though, if it corrects even lower. I've seen some analysts talking about around 3,750 being support. But anyway, silver also sold off significantly. We're back solidly under $50 an ounce, but like silver, we've seen a recovery this morning. And when I was doing show prep here a little while ago, silver was trading around $48.60. So we can look at the big sell-off and we can kind of try to parse it and analyze it. And we can ask the question, are the bulls dead? And the answer is, I don't think so, right? We've been in this bull market now for going on 2 years. And I don't think it's over because I still see those fundamentals that have been driving the gold bulls and the silver bulls. I see all of those things remaining in place. So it's important to keep this sell-off and any future sell-offs in perspective. As I put it in the podcast last week, keep your eye on the ball. Keep your focus on the fundamentals. And I went over a lot of those things in the show last week. So if you missed last week's show, go back and check that one out because I'll cover a lot of the things that might be on your mind in terms of what is still supporting the gold market. I talked about that last week. But this week, I'm going to focus more specifically on the inflation situation. But putting kind of the markets in perspective, remember corrections are healthy and normal in a bull market, right? No market goes straight up and neither does it go straight down. There are ups and downs and there are corrections and consolidations. And that's part of the market. You have to maneuver through those, and you have to kind of use your discernment to kind of figure out, okay, are we still in the midst of the bull, or is this a fundamental pivot? And so looking at the fundamentals is key. Don't get too caught up in the price action, especially on a daily basis, because you'll drive yourself crazy. You need to have a strategy. What are you doing? Like for me, I'm holding gold and silver for the long term. For me, it's my inflation hedge. So I'm not worried about, a $100 sell-off yesterday. I'm looking, 5-10 years down the road. So you kind of have to keep your investment strategy in perspective and keep what's going on in the markets in perspective, because remember, the markets react to every, post that gets put up on Twitter, right? So where are we now? So even with the big gold sell-off, gold is still up over 89% since January 1st of 2024. 89%. That's one heck of an upside. The yellow metal ran from $3,500 to $4,000 in just 36 days. Now, typically, those $500 increments have taken a lot longer, like 18 months, 2 years, right? 36 days, we went from $3,500 to $4,000. It's been a remarkable run, and it will end at some point. We can't expect, 89% upswings in a asset in a matter of 18 months is kind of the norm. So we should expect corrections, and there is no doubt that both silver and gold were oversold. And I talked about that in the show last week, what oversold means. It really just means that it has gone up faster than what the trend would project. And when an asset is oversold, then you start to consider the possibility of corrections. And we've certainly seen that. But again, the question that you always have to ask yourself is, are the fundamentals that push gold to record levels, are the fundamentals that pushed silver to record levels, are they still in play? And I think that they are. So what's driving the sell-off? Well, there seems to be two dynamics right now that are driving the current sell-off, or drove the sell-off that we've seen over the last couple of weeks. The first is simple profit taking. When you see such a big swing, when you see an asset go up $500 in 36 days, there's going to come a point where you're going to get a lot of speculators jumping in there. A lot of people chasing that increase, and they're kind of what you call in investing weak hands. They're going to be sifted out pretty quickly because they're looking for that big profit. When they see it, they're going to take the profit, they're going to sell, and they're going to get out. And we're seeing a lot of people doing that. And then, of course, when the price starts to drop, other people panic sell. So it's kind of a natural phenomenon that you see when a market goes up really fast. It creates an environment where big sell-offs and big corrections are possible. Now, I also mentioned the fact that, markets tend to react to things that happen in the news, and that seems to be a second factor that is driving both gold and silver a little bit lower right now, and that's optimism that the U.S. and China are on the brink of a trade deal. And, that's good news, and that's been one of the underlying things that I think has driven the precious metals markets up, and that's uncertainty with the trade situation, right? We don't know what Donald Trump is going to do next. And you can look at it on one hand and you can say, well, it's a really good negotiating tactic, right? It keeps everybody on their heels. It kind of gives him control. It keeps him in a strong bargaining position. That's all well and good, but there's a downside to that as well. It creates a lot of uncertainty and instability, what is known as regime uncertainty, and we're certainly seeing a lot of that right now. So, people said, "Oh, good trade deal," and that's good news, and it it makes people more willing to take on risk in the markets because they think maybe that there's going to be a little bit more certainty out there. Now, I question whether a trade deal with China is going to actually create real stability because let's just be honest, Donald Trump is unpredictable. That's his nature. That's his strategy. And again, it has its pluses, but it also has its minuses. And I don't think that we're, about to head into a period of market tranquility when it comes to trade. There will be other tariffs and other, trade pressures that will probably cause, the markets to get really risk averse, and we'll see another upswing in gold and silver. It just depends. But that's the news of the day, and it is driving the markets right now. So really what it's done, it's put investors in a risk-on move. Forex.com analyst Fawad Razakazda, he noted that as risk sentiment improved, the S&P 500 reached fresh record highs, leaving safe haven assets like gold on the back foot. However, uncertainty remains the name of the game, as I just mentioned, when it comes to trade policy. And Razakzada said that while these developments have lifted market spirits, analysts remain skeptical that the underlying issues, such as national security and tech competition, will be fully resolved. In other words, there's a lot of factors out there in the general, world of trade that are going to be much more difficult to resolve. They're not going to get taken care of in one deal, and that's kind of what I was alluding to. There's still a lot of uncertainty out there, regime uncertainty, and that is always going to be bullish and supportive for precious metals. So, even with the recent downturn, with the big drop in price, I still say there's a strong fundamental case for the bulls, with at least 5 factors still working in gold's favor. Ole Hansen is a commodities analyst for Saxo Bank. I like him. I read him quite a bit. I think he's pretty solid. And I think he put it best. He said, the reasons for holding gold haven't suddenly disappeared. And there, again, is that point that I made in the show last week. You've got to keep your eye on the ball. So I just kind of jotted down 5 things that I think that are kind of fundamentally out there that are still supporting the gold market. 1, falling real interest rates. We're moving into an era of monetary easing by the Fed. We're going to see interest rates drop. Real rates are already falling. That is bullish for gold because it takes away some of that opportunity cost that comes when you have a higher interest rate environment. Number 2, persistent inflation. Inflation isn't going anywhere. We're going to get into that in here just a second. Ongoing trade and geopolitical uncertainty, as I've already talked about. U.S. fiscal irresponsibility and de-dollarization. So you've got this national debt. I talked about last week, we've eclipsed $38 trillion. We went from $37 to $38 trillion in just like 2 months. That's not going anywhere. And people are wary. They're wary of the dollar because of the fact that we've got this borrow and spend cycle going on that nobody seems interested in addressing. And then number 5, systemic risks in the financial system. And by that, I'm talking about the malinvestments and the misallocations of assets that always happen when you have an artificially low interest rate environment. We still have not reckoned with a lot of the systemic damage that was done by more than a decade of easy money after the Great Recession, and then with the Fed doubling down on that during the pandemic. We've injected so much liquidity, so much inflation into the system. We've blown up these debt bubbles, or as my friend Greg Weldon likes to call it, the debt black hole that's kind of sucking everything into it. So those are kind of those 5 things that I think are still supporting the gold market for the long term. Again, these bullish fundamentals don't preclude corrections or even more prolonged periods of consolidation. Remember, after gold cleared $3,000 in April, we had a correction, and then gold basically traded sideways for 4 months. So, it wouldn't be a shock if we end up, moving into early 2026, still hovering around $4,000 an ounce or even a little bit lower. But again, keep your eye on those fundamentals. All of that said, I think the volatility is here to stay for a while. I think we're going to see big price swings. I'll link to an article in the show notes page that talks about why we're having so much volatility right now, and that'll help put that into some perspective. You can check that out over at moneymetals.com/news. But the bottom line, what I'm driving at here is don't panic at the big price swings, right? If you believe that gold still has long-term support, you should view these sell-offs as big buying opportunities, right? When you see gold below $4,000 an ounce, that might be a good buy signal. When you see silver down in the $46, $47 an ounce, these are opportunities to add to your position in a bull market that, again, would seem to still have support to keep going. With that in mind, I mentioned a few shows back that you can get 90% silver coins for really low premiums. And right now, you can actually get these junk silver coins. I'm talking about silver dimes and silver quarters. These are dimes and quarters that were minted prior to 1965, so 1964 and earlier. They're 90% silver. They call them junk silver, but obviously they're not junk. They're worth a lot more than your regular quarter, right? A quarter's worth a quarter. If you can find a 1964 quarter that's made of 90% silver, it's worth well over $8 right now, just in the melt value of that silver. And right now, you can get junk silver for 5 cents below spot. You heard me right. You can get this very popular and extremely liquid form of silver bullion and save big compared to just about any other form of silver. Again, 5 cents below spot price. That's a negative premium. And it's by far the lowest cost option in silver bullion right now. So you can go check that out at moneymetals.com, and I'll link to the junk silver page on the show notes, so you can check that out if you're interested in picking up some silver at a negative premium. Pretty good deal. So let's talk about the inflation situation. So the Bureau of Labor Statistics finally managed to get the September CPI data together, despite the fact that the government is still closed. By the way, have you missed the government? We've been closed now for like almost a month, and quite frankly, I'm fine with it. Don't miss it at all. Maybe we ought to think about doing some permanent closing of government. I don't know. I'm just throwing that out there. But anyway, the government's closed. The BLS did put together the CPI data. From what I understand, that was considered a high priority data set because it has impact on Social Security and not means testing, but inflation adjustments for those social programs. So got to get that out there. So they did. And the mainstream broadly characterized it as a good inflation report. And it wasn't. But it was better than the forecast. And in our world of politicized government data, that's good enough. As CNBC put it, the better than expected report, quote, keeps the door wide open for another interest rate cut next week. And let's be honest, folks, that's what all of this is about. Everybody wants rate cuts. Everybody's desperate for data that will support rate cuts. So even if the data doesn't really support rate cuts, we're going to try to spin it so that it does. Because by golly, we're getting rate cuts. Now, in a sane world, a 3% inflation print would put the brakes on monetary easing. In fact, I think in a sane world, you'd have a central bank that was contemplating raising interest rates, right? We're a full percentage point over the target. And yet, we're declaring victory over inflation and moving along. Why? Well, when you have a giant debt black hole, the economy can't function even in a moderately high interest rate environment. And this is modestly high. I mean, it's not a high interest rate environment, right? I saw a post the other day that was referencing the fact that that Paul Volcker, who was the Fed chair in the 80s, was able to slay the inflation of the 1970s. But the person that posted was Axel Merck. Axel pointed out the fact that it took a long time for Volcker to rein in that inflation. And, it occurred to me that he did it raising the interest rate to 20%. Now, that is a high interest rate environment, right? We're in the fours, so not really quite so high. So really what all of that means is the powers that be are going to spin the data however they have to justify rate cuts, because we have to have them. They have a choice between propping up the debt-riddled bubble economy and inflation, and they picked inflation. So what did the data say? Well, the headline annual CPI came in at 3%. So that was up from 2.9% in August and up from 2.7% in July. So what is the trend doing there? It's going up, right? It was the highest CPI since January, and it was up from a low of 2.4% in March. So, back in March, it was fair to start saying, maybe we've got this inflation thing under control. But from March, we've gone from 2.4% to 3%. However, the forecast was for 3.1%. So yay! Great job, right? Beat the forecast. Looking at the monthly price increase, we saw a 0.3% rise in prices. That's pretty healthy. It was slightly cooler than the 0.4% surge that we saw in August, but we still annualize 0.3% to 3.6% over a year. So, that's talking about a rate of nearly 4. And if you annualize the monthly CPI increase from the last 3 months, it comes to 3.6%. So there you go. However, the forecast was for 0.4%. So yay, we beat the forecast. If we strip out the more volatile food and energy prices, if only we could do that in real life, core CPI rose 3% on an annual basis. Now, that was down a tick from 3.1% in August. If we look at month on month, core CPI was up by 0.2%, and that was down from 0.3% in July. So, we could argue that the core looked a little better, but we've seen this before. The core has been bouncing around in this age for months. Over the last 4 months, if we look at the core CPI, we've had increases of 0.2, 0.3, 0.3, and 0.2. That annualizes to 3%. So core CPI has been mired in this range for months, and by months I mean years. So when you look at the CPI like in a graphical form, in a bar graph, and I'll put this in the show notes page so you can look at it if you want to over at moneymetals.com/news. But it's clear that inflation has been bouncing basically in the same range month to month since around mid-2022. But hey, the months or the numbers this month were better than the forecast. So yay, everything's great. Now, I would note that none of these numbers is anywhere near the mythical 2% target, right? Nowhere near. 3% is not near 2%. It's higher, right? All of those annualizations that we've talked about, well over 2%. In fact, I kind of think that we are heading for a world where the target's not 2% anymore. It's going to be 3%. We're going to get used to 3% CPI, and everybody's going to be like, well, that's not too bad. It's not 4. In 2, maybe that was unrealistic. That's what we're heading for, right? If you can't make the goal, then just change the target. I really see that coming. But for now, they still claim it's 2%. And we're nowhere near there. Doesn't look like we're getting anywhere near there. Hasn't looked like we're getting anywhere near there in a long time. And yet, we're declaring victory over inflation. And, as you parse the data, I have to say this every time I talk about the CPI, but you have to remember that it does not tell the entire story of inflation because the government revised the CPI formula back in the 1990s so that it understates the actual rise in prices. If we go back and we use the formula that they used back in the 1970s, take all of today's data, run it through the old formula, CPI would be close to double the official numbers. So when we're talking about 3% using the current formula, if we plug it into the 70s formula, we're talking probably about 6%. And let's be honest, it's probably even worse than that because I'm certain that the 1970s formula probably understated inflation. And you know this, right? If you're going to the grocery store or the gas station or, looking at your healthcare costs, you know that prices are rising a lot faster than 2% on an annual basis. Inflation is much worse than the government wants you to know. It has a vested interest in trying to make you feel like inflation isn't nearly as bad as it actually is. And, while we're talking about the veracity of the data, the recent massive revisions to the BLS employment data, kind of casts some doubt on government number crunching in general, right? How much can we really trust what this data is telling us? All of that said, though, this is the formula that the government uses. It drives decision making, so we have to consider it, and we kind of have to take it as face value because the decision makers are going to take it at face value. But, when we look at the data, even if we're skeptical about it, it's clear that prices are still rising rapidly in most categories. And if you look at the breakdown that the BLS gives you, like, for instance, the price for food at home rose 0.3%, and the overall food index rose 0.2%. That's in 1 month. Service prices were up another 0.2% month on month. Not percents, just 0.2% month on month. It's at 3.5% annually. So this is significant because you can't blame tariffs for rising service prices, right? So there's this underlying inflationary pressure that is still there. And as I wrote after the August CPI data came out, it's basically zombie inflation. It just won't die. And the fact of the matter is that inflation has been increasing for more than a year, right? And the Fed is about to crank up the inflation machine even faster. So the Fed kicked off its October meeting today, or yesterday. It'll finish it up today. And this is Wednesday, October 29th, by the way. And the central bank is expected to cut interest rates another 0.25%. And it also may well announce a timetable to end balance sheet reduction. I kind of think that they're going to. Jerome Powell hinted at that a few weeks ago. So quantitative tightening probably about done. So pretty significant loosening of monetary policy. But why? And it's kind of wild because a lot of the people who are clamoring for looser monetary policy also claim that the economy is booming. A booming economy and elevated inflation isn't generally a recipe for rate cuts. So why are we talking about easing when price inflation is well above the Fed's 2% target and rising, and the economy is supposedly great? In a sane world, the central bank would be holding rates higher to strangle inflation once and for all. It might even be hiking interest rates, as I've already mentioned. But we do not live in a sane world. We live in a world with a debt black hole. The debt-riddled bubble economy cannot function even with modestly higher interest rates. I know I've already said that. I'm saying it again because it is a key thing to understand. This economy needs the easy money drug. It got more than a decade of 0% interest rates when you count the era after the Great Recession and the pandemic era. And even when they started hiking rates, they were still low, right? After the Great Recession. We've had almost 2 decades of easy money. It is addicted to the easy money drug. And the Fed seems intent on supplying more of it to keep the party going. Inflation be damned. And, I've used this analogy a lot this year. The Fed is in a catch-22. It's walking a tightrope. It has to choose between fighting inflation and keeping the air in the bubbles, and it can't do both. It can't simultaneously cut and raise interest rates. That's not a thing. So it had to pick, and it picked inflation. Based on the October CNBC Fed survey, economists and strategists and fund managers predict that the Fed's not only going to cut rates at this meeting in October, but also trim rates at the next 2. And I'm not the only one that's questioning this pivot to easy money. I mean, a lot of people are wanting it, right? They're eager for the rate cuts. The markets love it. But not everybody is comfortable with the current situation. 92% of the people in that survey who responded, they said that the Fed would cut at the October meeting, but only 66% thought it should. 38% indicated that they completely opposed the next rate cut. Richard Bernstein, Advisor's CEO, said that he thinks politics are influencing the decision more than the economic data. He said financial conditions are near historically easy. GDP is tracking 3.5 to 4%. Financial assets are ripping, and inflation remains well above the Fed's target. In more normal times, there is no way the Fed would be cutting rates. So he just said what I said. In a sane world, the Fed is not talking about rate cuts right now. And he's right. All of those things that he said are right. The Chicago Fed's own National Financial Conditions Index indicates that monetary policy is currently loose from a historical standpoint. In fact, it never got tight from a historical standpoint, even at the height of the hiking cycle. Then there's the money supply. It's also screaming inflation. As of the end of June, the money supply had expanded, the end of August. The money supply had expanded by more than $600 billion since its low point, which was in mid-2023. As of August, the M2 money supply stood at $22.2 trillion, and that's above the peak reached during the pandemic when the Fed was doing quantitative easing. I cannot overstate this fact enough. This increase in the supply of money is inflation, right? That's what it is. Rising prices are a symptom of this monetary inflation. We saw this massive influx of money into the system during the pandemic, and what do we get on the other side? Price inflation, right? Now, during the Fed's inflation fight, the M2 money supply actually did contract a little bit. And this is exactly what needs to happen to wring the inflation out of the economy. When you inject $8 or $9 trillion into the economy, all of that inflation, if you don't want the impact, if you want to deal with the symptoms, the rising prices, you have to suck some of that liquidity out. The money supply bottomed a little over a year ago at $20.6 trillion. We're $2 trillion, almost $2 trillion above that now. Now, when you look at the decrease in the Fed's balance sheet, it has gone down quite a bit over the last couple of years, and it almost seems like an impressive inflation fight until you realize that the money supply would need to fall by at least another $3 trillion just to get back to the trend we were on in 2019. Clearly, that's not the trajectory here, right? And another reason that the Fed put is on is that there is significant softness in the labor market. Based on the BLS data, the economy only created 22,000 jobs in August. Meanwhile, the BLS erased nearly 1 million jobs from the data through revisions. We don't have any employment data for September thanks to the government shutdown. However, private payroll growth has been shown to be pretty sluggish. So the sagging employment picture signals economic contraction, right? It signals that there are ripples in this economy, or cracks in the economy, not ripples. And so, maybe the economy isn't quite booming as much as some people want you to believe. Now, what do we call it when we have low economic growth and high price inflation? There's a word for that, low growth, high inflation. Stagflation. That's what we have. So that's not the only thing that some of the mainstream analysts are worried about. A chief economist for Stifel said that there is concern about the lack of data due to the government shutdown and that it might be obscuring the full picture of what's going on in the economy. She said, quote, Fed officials are unable to draw much of a conclusion about anything and therefore should arguably remain on hold, waiting for additional information before potentially further compounding a policy error with a second-round rate cut if unwarranted by the evolution of inflation and hiring conditions. Janie Montgomery Scott, chief fixed income strategist Guy Liebes, likened it to, quote, flying in a blizzard with a blindfold on and no backup instrumentation. Sounds kind of dangerous. And he said it's even worse when there are mountains in the area. So he acknowledges that there's problems out there that we might be missing. And, this lack of good data is a fair concern. I would argue that there's always a lack of good data because the government's producing it. But, that's my bias. But the reality is, even with perfect data, central planning will fail. No brain trust can ever possess all of the knowledge necessary to run a complex economy. They are always going to run aground on the rocks of unforeseen consequences. But the fact of the matter is, what people lack in knowledge, they make up for in hubris. So they're going to keep trying. Central planners are going to centrally plan, and they're going to keep failing. Again, I can't emphasize this enough. The Fed is in a catch-22. It's walking a tightrope. It cannot fight inflation and prop up the economy with stimulus. So they're picking inflation. Not surprising, it's the fork they know. Whenever we've run up against a situation where the economy is collapsing, they will always forego inflation and run to the rescue of the economy. They'll run to rescue the stock market. They'll always try to keep the air in the bubbles, even if it's inflationary. If they have to pick a poison, they're going to pick inflation. So the bottom line is, no matter how you choose to parse the CPI data, if you're going to say, oh, it's good news because the forecast was worse, or, however you look at it, inflation is already increasing. Another rate cut coupled with an end to quantitative tightening is going to accelerate the increase of inflation. And it looks like the Fed is ready to push the throttle up on inflation. This isn't a situation that you can vote away. It's not a policy that's going to suddenly change. This is the way a fiat money system is. All you can do is try to shield yourself from the relentless destruction of your purchasing power. As I mentioned earlier, the relentless devaluation of our money is one of the reasons that I'm something of a permabull when it comes to gold and silver. No matter what's going on in the markets on a day-to-day basis, no matter how much the price swings, tomorrow, your money is going to buy less next year than it does today. Your dollar is going to devalue. It is a matter of policy. The only question is, how much are they going to devalue it? There is no such thing as a guarantee when it comes to markets, right? But this is about as close as you can get. The government is going to devalue your money. That's why you want to have real money. That's why after every show at the end, I say, call a money metals, precious metals specialist. Call 800-800-1865. Talk to those folks today. Get gold and silver. Use these dips as a buying opportunity. Your money's going to devalue. You want to hold real money. You want to shield your wealth. Our folks over at Money Metals, they can help you out. They can answer your questions. They can help you figure out how precious metals will fit into your investing portfolio, what products might be best for you, what your budget is, what's available. These folks are fantastic. Utilize their knowledge. I know a lot of folks don't like to talk on the phone in this day and age. You can actually chat online if you'd rather do that over at moneymetals.com. Or if you know what you want, you heard me talking about junk silver, you want to check that out, just go to moneymetals.com, search for junk silver, and you can actually purchase whatever you want on the website. We'll ship it straight to you. Or you can also have the option of storing precious metals in our state-of-the-art bullion vaulting facility, bigger than Fort Knox, beautiful, secure facility out in Idaho. So give us a call today, 800-800-1865. So with that, we're going to call that a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything that I've talked about on the show today and a lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up, get on our email list. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, make sure to tune into our Market Wrap podcast every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. Again, thank you so much for listening to the show. I really do appreciate it. Please hit those like buttons, share the episodes, and I hope you have a fantastic rest of your week. Fun Halloween, however you may do that. And I'll be back again to talk to you again next week.